The alarm screams at 5:30 a.m. Another Monday, another soul-crushing commute, another week of trading your limited time on Earth for a paycheck that barely covers your bills. But what if today was different? Imagine this. It's a random Tuesday. The sun streams through your window as you leisurely enjoy your morning coffee. Your phone pings. Dividend payment. $127.42 deposited. Later that day, another notification, $83.15. By the end of the week, these payments total over $500, and you didn't work a single minute for them. This isn't some fantasy or shady scheme. This is the reality for people who mastered one simple investment strategy I'm about to reveal. A strategy that requires just $100 a week, less than what most people spend on DoorDash and Starbucks. Let me be clear, I'm talking about generating enough passive income to completely replace your salary using a single ETF called SCHD. 3 years ago, I was drowning in financial anxiety. My rent consumed half my income. Credit card debt kept me up at night. The thought of an unexpected $500 expense terrified me. Maybe you know exactly how that feels. Then I discovered this dividend strategy that changed everything. I'm not a financial advisor or Wall Street genius, just someone who found a straightforward path that most people miss. Today, my dividend income covers 70% of my monthly expenses, and it grows larger every single quarter without me adding a penny. In the next 15 minutes, I'll show you and Eric the simple set it and forget it investing method. And why has this specific ETF outperformed 87% of other dividend investments? And the shocking math that turns $14 daily into a $1 million plus portfolio. And real examples of ordinary people now earning $3,000 to $5,000 monthly from this strategy. By the end of this video, you'll understand how this approach could potentially generate over $11,400 per month in completely passive income. That's $137,000 a year, more than double the average American household income, without working a 9-to-5 job. This isn't about overnight riches or gambling on the next hot stock. It's about building an unstoppable income machine that generates more cash every single year. If you're sick of the paycheck-to-paycheck hamster wheel and ready for a legitimate escape plan, don't skip a single minute of what I'm about to share. This could be the most profitable 15 minutes of your financial life. Before we talk specifically about SCHD, let's make sure everyone understands what an ETF actually is. ETF stands for Exchange Traded Fund. Think of it as a basket of stocks that trades on the stock market just like an individual stock would. When you buy one share of an ETF, you're essentially buying tiny pieces of dozens or even hundreds of different companies all at once. This gives you instant diversification, one of the most important principles in investing. Instead of putting all your eggs in one basket, by buying shares of a single company, ETFs spread your risk across many companies. Let me give you a real-world example. Last year, my friend Sarah inherited $10,000 from her grandmother. She was considering buying shares in Apple because she loves their products. While that might have worked out fine, but instead, I suggested looking at ETFs. She ended up investing in a broad market ETF that included Apple and hundreds of other companies. 6 months later, when Apple had a rough quarter and dropped 15%, her ETF only dipped about 3% because the other companies in the fund helped cushion the blow. There are thousands of ETFs, each focusing on different sectors, countries, investment styles, and goals. Some focus on growth companies, others on value stocks, and some, like the one we're talking about today, specifically on companies that pay solid dividends. So now that you understand what an ETF is, let's talk about the specific one that could potentially replace your salary. SCHD. SCHD is the ticker symbol for the Schwab US Dividend Equity ETF. As of March 2025, it's trading at $27.64 per share, and it manages a massive $68.36 billion in assets. That makes it one of the most popular dividend ETFs on the market, and for good reason. SCHD was established back in October 2011 and is managed by Charles Schwab Asset Management. Its primary objective is to track the performance of the Dow Jones US Dividend 100 Index, which is essentially a collection of companies that form the backbone of the American economy. What makes SCHD particularly special is its focus on quality. It doesn't just chase the highest dividend yields, which can often be a trap. Instead, it looks for companies with strong fundamentals and consistent dividend payment history. Here's what makes SCHD stand out from other ETFs. First, it has an incredibly low expense ratio of just 0.06%. That means for every $10,000 you invest, you only pay $6 in annual fees. That's 87% lower than the average expense ratio for dividend ETFs, which is around 0.47%. This matters because every dollar you don't pay in fees is a dollar that stays invested and working for you. Second, perhaps most importantly for our discussion today, SCHD offers an attractive dividend yield of 3.60%. That's more than double the yield of the S&P 500, which is around 1.58%. And not only does it pay a higher yield, but it's been growing those dividends at an impressive rate of 15.56% annually over the past 5 years. Let's pause and really think about what that means. A 15.56% annual dividend growth rate means your income from this investment could potentially double every 4 to 5 years without you adding another penny. So what exactly are you buying when you invest in SCHD? The fund holds 105 different companies, significantly fewer than broader market ETFs like VOO, which tracks the S&P 500, but still plenty for solid diversification. The selection process is quite rigorous. To be included in SCHD's underlying index, companies must demonstrate at least a 10-year history of paying dividends. They must also meet strict criteria for financial strength and fundamental quality. Let's look at SCHD's sector allocation to understand what industries you'd be investing in. Financial services make up the largest sector, accounting for 17.76% of the portfolio. This includes companies like BlackRock, the world's largest asset manager, Blackstone, one of the world's leading investment firms, and US Bancorp, one of America's largest banking institutions. The healthcare sector represents about 17.58% of the fund, with companies like UPS, Lockheed Martin, and Automatic Data Processing. The portfolio's consumer staples sector stocks comprise roughly 14.87%. These include household names like Home Depot, Ford, Coca-Cola, and Altria Group. One thing you'll notice is that SCHD is relatively light on technology stocks compared to the broader market. This is common for dividend-focused ETFs because many high-growth tech companies reinvest their profits into expansion rather than paying dividends. Understanding this sector allocation is important because it influences the fund's performance in different economic environments. SCHD tends to be more defensive during market downturns, but might lag during tech-driven bull markets. So that all sounds good in theory, but has SCHD actually delivered results? Let's look at the track record. Over the 5-year period preceding late 2024, SCHD generated total returns of approximately 70%. That's the combined effect of share price appreciation and dividend reinvestment. Over a 10-year time frame, it has delivered returns comparable to VOO, which tracks the S&P 500. But the real power of SCHD isn't just in its total return, it's in its growing income stream. Let me tell you about Eric. Eric started investing $500 a month in SCHD back in 2015 when he was 35 years old. At first, the dividends seemed insignificant, just a few dollars each quarter. But Eric stayed disciplined, continued his regular investments, and reinvested all the dividends. Fast forward to today, and his SCHD position generates over $1,500 in dividend income every month. That's $18,000 a year. Enough to cover his car payment, utilities, and groceries, and he still has some left over. And the best part, those dividends keep growing year after year, even if Eric never adds another dollar to his investment. What's even more impressive is SCHD's dividend growth. The fund has consistently increased its dividend distributions, with a 5-year compound annual growth rate of approximately 15.56%. That significantly outpaced the dividend growth rate of 6.36% for the S&P 500, tracking VOO during the same period. To put that in perspective, if you were earning $1,000 in annual dividends from SCHD 5 years ago, you'd be earning about $2,075 today, just from the dividend increases alone, without adding any new money. You might be wondering why I'm so excited about dividend growth when you could just chase the highest current dividend yield. Let me explain why dividend growth is actually more important for building wealth over time. Companies that consistently grow their dividends year after year tend to be financially healthy businesses with strong competitive advantages and management teams that are committed to rewarding shareholders. Think about it this way. A company can only sustain dividend increases if its business is growing and generating more cash flow over time. When a company raises its dividend for 10, 20, or even 30 consecutive years, that's a powerful signal of its financial strength. Let me show you why this matters with a quick example. Imagine two companies. Company A pays a 6% dividend but hasn't raised it in 5 years. Company B pays only a 3% dividend but has been increasing it by 10% every year. In year one, a $10,000 investment in Company A would give you $600 in dividends, while Company B would only give you $300. But fast forward 10 years. If Company A's dividend still hasn't increased, you'd still be getting $600 per year. Meanwhile, Company B's dividend would have grown to about $778 per year, now surpassing Company A, and that gap would continue to widen every year thereafter. Now, considering that SCHD has been growing its dividend by over 15% annually, you can see why it's such a powerful tool for building passive income over time. Another reason dividend growth matters is inflation protection. With inflation running around 3 to 4% in recent years, a static income stream is actually losing purchasing power over time. But dividend growth that exceeds the inflation rate means your income is actually increasing in real terms. This is why patient, long-term investors focus on dividend growth rather than just the current yield. And that's why SCHD has become so popular among those building retirement income streams. Now let's get to what you've all been waiting for, the actual numbers. How exactly can $100 a week into SCHD eventually surpass your full-time job income? I'll break it down step by step. $100 per week equals $5,200 per year, which is about $14 a day. Less than what many people spend on lunch and coffee. Let's say you invest this $100 weekly in SCHD and reinvest all dividend. Based on SCHD's historical performance, let's conservatively assume an average annual price appreciation of 7%, a starting dividend yield of 3.7%, dividend growth of 10% annually, which is actually lower than SCHD's historical 15.56%. Here's how your investment would grow over time. After 10 years, your total investment will be $52,000, and your portfolio value is approximately $86,000. And your annual dividend income is around $4,600. After 20 years, your total investment will be $104,000, and your portfolio value is approximately $320,000. Your annual dividend income is around $28,000. And after 30 years, your total investment will be $156,000, and your portfolio value is approximately $1 million. Your annual dividend income is around $137,000. That's over $11,400 per month. Look at those numbers again. After 25 years, your $100 weekly investment could be generating $62,000 in annual passive income, more than the median US household income. And this is without ever touching your principal investment. This is the power of consistent investment combined with dividend growth and compound returns over time. And remember, these projections are actually conservative compared to SCHD's historical dividend growth rate. So there you have it. And don't forget to watch my next video where I'll show you how 5 monthly dividend ETFs in 2025 can potentially accelerate your timeline to financial freedom.